Hi everyone, welcome back to your Excel Ninja. It has been a while simply because of work commitment, but I'm back to share with you an example of one task where you make an investment analysis for a made up amusement ride business on purchasing a ride facility. Now, this is going to be my first tutorial on financial context, and so please also visit our website at yourexcelninja.com to start learning Excel essentials as well as coaching sessions. Let's get started.
All right, so this video is made to walk you through the building of the data model about Ocean City Water Park investment analysis. Uh, to start off, what was needed is a list down of all the parameters. As you can see in slide investment analysis, it is best that you list all the given metric. Number one, equipment cost, which is this value. And these are all pretty much straightforward, just writing them down. So that's equipment cost, installation cost, project life, which is 6, which is also in the paragraph. The class life in the depreciation system is class life number 7. And then there's a rides per day given variable. There's a riders per ride, is 35. Operating days per year is 120 days. The first year ticket price given is $5.25. It was also given that the annual ticket price increase per year is 4%. And then the variable cost per rider is $1.65. The fixed cost per year is $525,000. Dismantling cost is $245,000. Salvage value is $600,000. Cost of capital, which is also equal to the discount rate, it's 8.50%. Marginal tax rate is 25%. Again, these are all given simply in the paragraph of the exercise or the assignment. Now, it is also best that you list down the depreciation rate for the 7-year class. And this is published, this is actually found online through many sources of MACRS. It's a public document. It's a published information. You can get that from Wikipedia and all that, but this is a standard for a 7-year life. So in year 1, the depreciation is 14.29% of the value of the asset. In the second year, 24.49, and so on. And this is a standard for a 7-year class for MACRS depreciation. Now, of course, the exercise requires a cash flow analysis. And because it's given that there's only 6 usable life in years of the equipment. So you start with year 0, which is the time you were able to purchase it. And then when 1 year is elapsed, that's represented by year 1, year 2 for the second, third, fourth, fifth, and sixth, and so on. And of course, for this cash flow analysis table, you will need the initial outlay, which simply means your initial investment. And it is given in the paragraph that it's about 8 million is the cost of that equipment. The cost of installing that is $475,000, and the total initial outlay, which implies now the total of both, is simply the addition of both, which is 8.475 or 8.475 million. In accounting, they will be in a negative format because it's the nature of a cost. They're always negative when it comes to accounting, or at least in the NPV context. And so after that, of course, in the table, there should be under year 0 because that's the time of the purchase. And then, and then for the other line items now, in a category of cash flows now, you might want to list down the riders, the number of it, the ticket price parameter, the revenue, which is The revenue here is measured by the number of, I mean, the price of a ticket multiplied by the number, of course, of the number of expected riders. So it makes sense that you multiply the price of the ticket with this amount of riders for year one. And of course, the result is 3.3 million approximately. And that's how this line item is measured. And you'll see that it does the same thing in the second year. You see, you always multiply the price of a ticket to the number of riders who will buy that ticket. And that's for the second year. So all is the same logic and calculation until year 6. Next is variable cost. Okay. The variable cost is given. All right. Okay, the variable cost is going to be definitely, well, it will factor in right here, the number of riders. Okay, for the first year, the cost will be derived, will be referring to the variable cost per rider. It's given, okay, $1.65. But since there are 630,000 riders for year one, then you get the product of 1.04 million approximately. And again, it's an accounting because you're multiplying a negative value to the number of riders. Okay. I'm sorry, the number of, sorry, you are going, this is a cost, so it's always going to be a negative. Okay. And the same, everything else is going to follow the same measure accordingly. You'll see that in year 4, it also follows that it's going to be a product of the well, per rider, variable cost multiplied by the number of riders in total for that particular year. And they will all have the same number of riders per year. By the way, the number of the 630 value was calculated by multiplying the number of riders per day, per ride, and the number of days that it will operate in a year. Okay, and that's how you got 630,000. It's all the same every year, and because that is how the problem was given. And of course, moving on, we have fixed cost. The fixed cost is simply again, it's also constant. It's given per year as referring to the parameter up here, 525K. Okay, so it will be constant because that's how it is given in every year. That's understood. Now the depreciation base is simply the in investment, the total outlay, and that is simply referring to this thing that you've declared on a little bit on the upper part of the cash flow analysis table. And again, it's an accounting format, so it's negative because it's a no, actually, ignore that. It is as what it is. What it is. It's just the value of the asset right here. Okay, so it was just formatted as it was just given. It was just turned positive for the purpose of showing the user or the people referring to this table that's just what the value is. For now, it's not considered a cost. It's just displayed as it is, but it will be taken care of as a cost later on when the cash flow at the bottom will be calculated. So moving on, depreciation base is just simply pointing out the absolute value of how much are we basing our depreciation rate from. Okay, so, and it will appear by the way that it's since the depreciation base is just referring to the amount of the value that you've invested with this with this asset, it's gonna stay the same for all years. Okay, and then of course the depreciation rate is this is where you now will be using your reference right here. So when it's the first year of a 7-year class MACRS, classification, it's going to be 14.29% for the first year, 24.49% for the second year, 17.49% for the third year, and so on. Again, these are all given. Um, and it's also in a sheet right here. I have pasted it coming from Wikipedia or from other financial website. You have a reference of what it is. Here's the table for that. As you can see, the 7-year, the matrix for the MACRS for the 7-year class, which is in this column, the D, starts with 14.29 for the first year, 24.49 for the second year, 17.4 for the third year, and so on. I'm just showing you that this is exactly how how it was extracted from. Okay, the other value on the right of it is just a decimal, like a format of it, which will be used later on the other section of the sheet for the main sheet right here. So that's just this is useful for referring to it. All right, now going back to the main sheet, which is the investment analysis. So down here, I just showed you how these numbers were, were taken from. Okay, they are simply referring to what I just explained as the standard rate of depreciation. And so the depreciation item right here, next row, is simply getting that amount, which is 14.29% of 8.475 million, and it's going to be, the result of that is 1.211 million. And you'll see that even in the formula right there. See, they are just multiplied to each other. Okay, and they are the same across all the rest of the columns for different years. Okay, this is year 2, year 3, 4, 5, and 6. They have the same logic. Now the earning before tax is the next line item. It is simply the summation of the following. Okay, all right. It's summation of the revenue. This is a standard formula in finance. Okay, you always add up the revenue, subtract the variable cost, which in here they appear to be all plus, but the negative signs of the values here takes care of the deduction. Okay, and that's why, by the way, that's the reason why they have to be negative, because when you sum them all up to compute for the EBT, they are going to be they're going to be a minus operation instead of a plus. It's important for analysis. And so as you can see, it's basically a summation of revenue minus variable cost, okay, and then minus fixed cost. So depreciation, the depreciation result, okay, this one, all right, and then pretty much 1, 2, 3. Yes, that's it. The addition of these 4 values, and that's a standard formula. So after doing that, you kind of fill down that formula all the way to the right, and you should get the same logic. If I inspect the next column, EBT, you'll see that it uses accordingly the revenue, variable cost, fixed cost, and then we have the depreciation itself for that particular year, which is year 2. So I'm just showing you that they must all be referring to their own columns, and just go ahead and just refer to the formula, and then if you construct this yourself from scratch, just copy the formula if you refer to this model and paste it, and then you go here and then copy the same formula, or you can just simply drag the corner if you started on this cell and enter that formula up here, and if you want to apply it all the way to the right, then just drag this corner all the way to the right. Or if you have trouble with that, just simply manually copy formula cell by cell. Now let's go to the next line item in this cash flow analysis, taxes. Taxes is simply measured by what you get as an EBT, which is above it, multiplied by the standard parameter uh, marginal tax rate. That's the standard formula for taxes when it comes to investments, okay? And that's the same value over here, and here, and here, and here, and here, okay? All right, now they can be negative, they can be positive, depending on the value, okay? But yeah, there you go. See, the taxes is always the EBT above it multiplied by uh, the marginal tax rate, reference over here, always at the B18. And now, again, just fill that formula across all columns. Now, the net income is measured by subtracting the EBT by the taxes that you calculate below it. Okay? That is your net. That's why it's called net income. Okay. Same thing formula. You fill it down across all columns, and you should be able to give that output. And then of course you need to add back the depreciation because it was deducted earlier in the EBT over here. Okay. And the reason for that is because the depreciation is not considered a cash, part of a cash flow. So you need to add it back so that it gets accounted. I mean, it doesn't get removed from the accounting of the annual cash flow. So there you go. So it's just a reference to this depreciation row item only turned into positive value. Okay, and that is taken care of by the negative sign of this formula. Okay, same thing here. Okay, that's because if you're adding it back and considering it an earning or a cash that comes in, then you have to turn it positive. That's why there's a negative in the formula to turn it to positive. And then finally, the line item that will be the most important line item is ultimately the annual cash flow. It's a cash flow that is measured entirely for that 1 year. It is simply measured by the addition of your net income and the depreciation that you added back. That's why annual cash flow considers the annual cash flow considers your depreciation, but but for EBT, if you'd like to list it down, you have to consider it in EBT for a proper earnings before taxes. Okay, because you don't want to tax your earning by the depreciation. Okay, that's why you have to subtract it right here. All right, that's the annual cash flow. This is important because this will then be calculated down below over here. But let's talk about terminal cash flow first. Okay, terminal cash flow is the parameter of financial parameters at the end of the life of the asset, meaning you're about to salvage it and then get some earnings from it. So 600K is the salvage value. I think this is given up here. Yes, single, and there you go. It's given in the problem. Okay. So that's one. You have to list it down to be clear. And then the tax on salvage again is measured by multiplying the marginal tax rate. Okay, because that's the tax on salvage actually, by the thing that you earn from it, which is salvage value 600K. So you have to pay some taxes for earning that amount. Okay, which just happens to be 25%. That's just what it means by tax on salvage. Okay, and then the dismantling cost, however, there is a cost in dismantling it. So there's there's an expense of 245K. That's also given, and there you are in the parameter listing early in the model right here. Okay? All right, and then the terminal cash flow finally, because you want to total it now. You'd like to know what came in as a cash after deducting all your tax on salvage as well as dismantling cost from your salvage value. And it happens to be 205K because 600K minus 150 minus 245 is 205K. Then finally, there's a line item which finally will be used in your net, value measure, or what we call NPV. You'll just have to drop whatever you get from that column. As you can see, just sum it all up. It appears to be 8475 if you sum all this up. Okay. Actually, yeah. What I mean by that is this: you sum this up, but actually, this actually is a sum of already for both of them. That's why you have the 8475 here. Okay, that refers to the total investment. So in the cash came in, I'm sorry, it actually came out. Okay, it's a cash flow, but it's an outward flow. So it's negative 8475 million. But for the first year of life that has elapsed, you now have to account for the annual cash flow. So just drop it right here. Okay. So basically, you just this row item just simply picks this value and puts it here, basically, on all of them. As you can see, it's a mirror of it. There you go. This cell and this cell. However, on the last cell, it's a different logic. I have to take note. This part of it is the only cell that doesn't mirror the thing above it because it's measured differently. It is going to account for the summation of the annual cash flow at the end of the life, which is 2.03 million, which is already here. That's the annual cash flow initially measured, but this time it subtracts the terminal cash flow from it. Sorry, it adds the terminal cash flow because that's an added value. Okay, so your total cash flow, that's why it's called total cash flow, because it adds anything else that you gain from it, which is 205K more that you got from from selling the value of what you salvaged. You got yourself another cash in the business. Okay, so yeah, this row will now be used in measuring your net present value of your business, okay, or investment in this context. So it is simply using the following Excel function, NPV. The parameters of it is it requires B17, which is the cost of capital. That's always required by NPV, hence it's given. And then you also in the NPV function, you also give you also point out where is the total cash flow array or table or the row for it to measure. So you did it by C59 to H59, which means all these red cells here is what you give the function as a parameter inside its formula right there. And after getting the NPV, the true NPV is that you also add the initial outlay. In this case, you're subtracting, although it's plus sign here, but this one has a negative. It will really subtract your total initial inlay, or in this case, the total cash flow for year 0. Okay, and it's always negative because you're investing at at year 0. And you should get 121K approximately of NPV. So the investment is actually about this worth at the moment you decide on the investment, and it is good. You always want NPV to be positive, and so to move on, the IRR is also calculated with its own function in Excel. It's called IRR, but it only needs one parameter or argument. It is simply needing the total cash flow, everything there now. Now you account for not only the yearly cash flow, but include year zero, okay? Whatever that amount, negative or positive. And just simply, give that IRR function from column B to column H, okay? Now the MIRR this is written differently. Now it has two arguments. It has to you have to give the blue section pointed to B59 to H59, but you also give a parameter of what the cost is, which is cost of capital. So you include the cost of capital, give it the finance rate, and then the reinvestment rate is also the same in this example. In this example, just understand that finance rate and reinvest rate is the same in this scenario. That's about what MIRR is and how that number was generated. The next instruction is to create a data table about the effect of depreciation matrix or schedule along the 6-year usable life. That's because you have the option to use any of the MACRS class. Originally, the problem or the exercise is using the 7-year, but on the last part of the exercise is a question or an instruction to give us a table of what it looks like for the NPV, the IRR, and the MIRR if we if we change the year class of the depreciation system into something like 3-year, 5-year, 7-year, 10-year, 15-year, or 20-year, a kind of a reference of how it looks like on the value of the investment. And of course, the key in doing that is you have to create the best approach is to create multiple sheets that calculates the NPV, the IRR, and the MRR using varying class right there. You can see here. So how it was done is that upon creating the model on at this point in row 64, I did not right away create the further information that you'll see down here. I duplicated the sheet 1, 2, 3, 4, 5, 6 times. And then when I did duplicate that, by the way, you duplicate that by doing this, right click, move or copy, and then you pick the name of that sheet, okay? And then you hit OK. Oh, by the way, you hit create a copy. Okay, that's it. And then you hit OK. Once you do that, you get a duplicate of that sheet and give it a suffix of number 2 for you to identify it. So the next thing I did is I renamed it to say something like 3-year. Okay, that's what I did. Now I did put an underscore there because there's already a sheet existing with a 3-year, but I originally did it with a 3 space year as a name of the sheet. And then what I did next was I took out the so if this was the 3-year, I had to refer back to if this is 3-year, okay. Oh, let me go back to the table above here. Okay, yeah, there you go. So the 3-year that I originally did, it's what I did for the 3-year is I kind of, yeah, this is what I did. On the 3-year, this is the duplicate of investment analysis, as you saw. I took this out, all that value, because it will be different now. Okay, for a 3-year, and also I removed that. I edited the title from 7-year to a 3-year class. That way, it will be labeled accordingly. And then I think somewhere in this cell, I create a helper cell. Go back to 3 year, and I called it class, and then there's a number there, and you'll see in a bit why. So I said class in this cell. Next cell to it, I now say the number 3. Okay, and I created a highlighted with a yellow so I can I know what to change, how to change it into. And so what I did was I simply went into this item and used a formula. I think I used XLOOKUP here. Okay, and then I looked up the number. Oh, this one. I look up this number, which is 3. So I put a comma. Now I went. Now it's asking me for a lookup array. So I go to my MACRS. Okay, while I'm in the formula editing mode, simply navigate to MACRS, and your formula bar will now say MACRS up here. But then you still need to to complete the entry of lookup array. What you do is you look up the array in here. You look it up from here to here. Here you go. Because that's where number 3 is the lookup value is found right here, number 3. And after doing so, you must also highlight. See, it says A1 to M1. That's because it really is A1 up to M1 as a range. You need to modify this range, highlight it, and put a $sign to make it an absolute reference. Okay, and you put a $sign, in front of the letter and the number. Okay, hold on here. Let me go back to the 3 year. Sorry, I think that was here. Okay. You highlight this entire thing. And I think, yeah, that's right. Okay, there you go. Your lookup array should say exactly like this. Okay. All right. And next, you give it the return array. Of course, what will you need the return array for will be you'll have to highlight the same size of array below it. So this time it's A2M2. Now you don't want to put $signs to it. You want this to become a relative reference so that it can be used further down when you fill the formula down back in the main sheet, okay? Or in the 3-year sheet. And this should suffice, and you now must close your formula with a close parentheses. Okay, and if I hit the check mark or hit enter on my keyboard, now back in the 3-year, the duplicate of investment analysis has now been modified with a dynamic value called 33.33%. And if you go back to the MACRS sheet, year 1 of a 3-year plan or life is really a 33.33% depreciation rate. I expect the recovery year number 2 to be 44.45, 3 to be 14.81, 7.41 for the year 4, 0 for the 5th year life of the asset. It's still 0% in the 6-year life of the asset. And let's take a look if it does that. So if I fill this down all the way till presumably until the 8th life, but apologies for that. Oh, the D20, by the way, should be also absolute. See, it has to be locked in there. So what you need to do is put $signs as well in that location or address. So I'm gonna hit return or enter. Now if I fill it down, should no longer be errors. And there it is. As you can see, it's 33.33, 44.45, 14.81 for the 3rd year. And if you go back to MACRS, you will indeed see that it is the set of numbers really, it's 33, 44, and it's 0.41. And that's how I made that modification of the duplicate of the sheet, of the main sheet, so I can kind of make this sheets right here. These are the finished varying. See, there you go. They are the MACRS in this different sheets are varying because of the class. Okay, just this is the 5-year class. This is the 20-year class. All right. This is the 15-year class. Okay. And so on until you get to the all the years. And how did I do that? I simply when you're done here, uh, you can already kind of duplicate it again. So you can make until the 20 year. Okay, you can do this and hit see that 3-year I created just now for this demo. I hit it again, and there you go. And then just name it the sheet name from 3-year to 5-year. There you go. Just like that. That's how those other sheets were created. And by the way, let me delete the sheets now. No, so not to confuse. Okay, they're deleted. I forgot to tell you that actually you should first. No, actually, that's right. You have to really do that on all of the sheets. Sorry. Yes, that's it. After creating row 64, that's when you create the varying sheets with the specified, the thing that I just, demoed on how to change them, because they need to, the thing is they need to have this changes or variance in the matrix of the depreciation table. There you go. That's how I created them. They play an important role in creating the data table effect of depreciation of the asset for the 6 years. So what I did was I labeled MACRS class on the first column and then named them accordingly. 3-year, 5-year, 7-year, 10-year, 15-year, 20-year. Okay. And then the other columns here, I prepared a column for the net present value, IRR, and MARR. But for the following, you see, I need to refer this. So what you do is either you highlight this, pretend that this is a blank, and then you go to the 3-year. See, this is 3-year. You go to the 3-year and point to cell NPV. There it is. Just click here. Once you click here, it will turn it into this value. See, 489,045.87. Right now, please don't get confused if you see indirect right here. This is just my method for a faster way to generate it. But it's the same thing as, watch this. I'm going to delete it now. I do a so once I do an equal sign first, and then I go to the 3-year because this one is referring to the 3-year context, and specifically the NPV of that sheet. I go to the 3-year sheet, which is this, and then I point it to NPV. As soon as I do that, that's how it writes it. Okay, 3-year B62. Just accept that. Don't worry about the formula. Just hit enter or return. See, it says the same thing. 489 is the NPV for that. And do the same thing for all. For the 5-year, you just go to 5-year and point it to the NPV of this 5-year, which is in the B62 of every sheet. There will all be the same B62 range. Okay, so 20-year, it's in B62, and so on. 15-year, it's in B62. And then for IRR, you will, for the go to 3-year, refer to B63. For MIRR, refer to B64 of whatever sheet that refers to that. See, it's B64. Okay, B64. So going back, yeah, once you're done, you just fill them as needed, and then after doing so, you should get exactly like this. Okay. Now the exercise is asking for your observation on what you notice in this table. Uh, it appears that that the depreciation schedule, the effect of it appears to be positive. It appears to be favorable for anything from 7 year to earlier year class of the depreciation system. Anything after 7 year appears to be unfavorable for investing. Okay, because now your net present value is now showing that it's going to cost you more rather than gaining anything if you kind of decide to proceed with that MACRS class in managing your taxes. Okay, so it is in here. So I wrote a description that the shorter the MACRS class is, you get a higher NPV, IRR and MIR, which generally means the higher the better. And because of that, the observation is that larger tax, the largest tax shields in earlier years is what's contributing to the positive value. All right, that's what this observation is all about. Okay, now the exercise also wants to find out what's the minimum ticket price for the first year so that you can break even, which means NPV is equal to 0. Well, goal seek is exactly what this is used for. So what you do, for now, remember that what's given is that the ticket is $5.20. So you have to remember that. But goal seek will take care of changing that value for the sake of reducing the NPV here to turn it into 0. And how do you do that? Well, you could use this, any cell actually will do. I use this cell, B11. Sorry, not cell B11. Just simply, it doesn't matter what cell you are. I'm using A77, and I just simply go to data, and I go to the what if analysis and hit goal seek. See, there's no need to specify or to output any number in any cell. You actually just set the cell yourself. So set cell simply asking what are you trying to turn into a 0 or to anything. In this case, NPV into 0. So you click on this button here so that you can point to what cell is NPV is. But NPV is in cell of the analysis is in cell B62. So I say B62 over here by simply clicking on that cell. And I click back on the expand button. Now Excel's goal seek is asking you what value to turn it into or to set it to in it, as your goal. Well, you set it to 0. You manually just type 0. It is also required that you also give the cell, that single cell that you will be changing it, or goal seek will change, to compute really quickly to find out what number will revert to 0. So you click on that in that field and click on the collapse button over here, and you have to select the as requested by the exercise or the question of what is the ticket price that will make it break even. So when we say ticket price, then refer the goal seek dialog to the ticket price parameter. That's it. It's B11. Okay, that's the first year ticket price of the first table of your investment analysis model. Now you hit on the expand button, right here, and now you get you see now a complete setup right here. And now, after doing that, you can hit OK. So what it's going to do is it will change all these values in the cells, B62 and B11, accordingly to satisfy 0 in NPV, in B62, okay? As soon as we do that, goal 6 says it found a solution and it was achieved. You hit OK to find out what that price is, okay? And sure enough, the price is reduced to 5.19 or approximately 5.2 dollars for that ticket price to break even at least. And that's how we came up with this cell that describe or answers that question. What's the ticket price to achieve NPV equal to 0 or to break even, okay? 520. So you might want to bring that ticket price back to 5.20. Remember, you have to remember that, so that your NPV value will still be accounting for the given, ticket price, first year's ticket price. So it has to return to 489 here. Sorry, 121 here, okay, for 7 year. That's pretty much it. That's how you build the model. Just refer to the formula bar if you'd like to replicate that cell. To learn more about Excel and other data essentials, visit www.yourexcelninja.com to get started. We also offer one-on-one learning sessions.